Welcome to this comprehensive lecture on the fundamental pillars of financial recording, rules of debit and credit, and the mechanism of journal and ledger. To begin, we must organize or recognize that accounting is the backbone of the global financial world. Every organization, from a small local shop to a massive corporation, relies on a systematic way to track its resources. Think of accounting as a specialized language, a way of telling the story of a business through its transactions. But why do we need such a rigid system? In any business, money flows in and out constantly. We have sources of money such as sales of goods or interest from banks, and we have expenditures such as rent, salaries, and maintenance. If business does not track this carefully, it cannot survive. The primary goal is to keep expenses low and sales high enough to ensure that the owner's capital remains protected and grows. As we progress, we will see how the double entry system provides the reliability and clarity needed for this task. Before we dive into the lecture, let us outline our roadmap for today. By the end of this lecture, you should be able to understand and explain the rules of debit and credit as they apply to journal and ledger entries. Master the mechanics of an account, specifically in the T account format, classifying accounts accurately using both the traditional British approach and the modern American approach. Identify the significance of debit and credit in maintaining the balance of financial records. These objectives are designed to move you from a basic understanding of recording to a professional level of financial analysis. The foundation of modern accounting is the double entry system. This system is built on a simple yet profound observation. Every business transaction involves an exchange between two accounts. There is no such thing as a one sided transaction. If you buy a laptop for your office, you receive an asset, but you also have to give away your cash. This twofold aspect, the giving and the receiving, is the essence of what we have called dual asset analysis. Historically, this system was refined in Italy by Luca Pacioli during the 15th century. Though it saw significant development later in England, it is based on the principle that every asset there is a corresponding claim on that asset either by the owner or by the lenders. This ensures that the total amount debited to one or more accounts always equal to the total amounts credited to others. Theoretical question: why is it so vital that debits equal credits? The answer is because this balance act as a built-in error detection mechanism. If the total do not match the other side, we know immediately that the bookkeeping error has been occurred. To appreciate the double entry system, we must compare it to the single entry system. The single entry system is often described as unscientific and incomplete because it fails to record both sides of transactions. It is typically used by very small businesses where the owner personally supervises every cent. However, for complex organization, it is insufficient. The double entry system offers several distinct advantages. First, it allows for the accurate calculation of profit and loss. Second, it includes all assets and liabilities, providing a full picture of the firm's financial health. Third, it enables the preparation of a trial balance to check arithmetical accuracy. Finally, it makes the detection of fraud and errors much easier. In short, it provides a reliable record that management can be used to make informed, data driven decisions. Now, let us look at the primary tool of the bookkeeper, the account. An account is a summarized record of all transactions relating to a specific head, such as cash, rent, or furniture. Instead of a long list of sentences, we used a T account format. As you can see, the account is divided by vertical line looking like the letter T. The left side is always the debit side, abbreviated as DR. and the right side is always credit side, abbreviated as CR. The title of the account sits at the top. We record increases on one side and decreases on another side, depending on the type of account. The difference between the total debit and credits is known as the account balance. This balance tells us the net value of that specific category at any given time. To apply the rule of debit and credit, we must first know what kind of account we are dealing with. Under the traditional and British approach, accounts are classified into three main categories: personal, nominal, and real. Personal accounts are related to individuals, firms, or institutions. Real accounts deals with properties and assets that are permanent in nature. Nominal accounts are used to be define the nature of transaction involving expenses, losses, income, and gains. Brief recap. So far, we have established that every transaction has a dual aspect and we record this in T accounts. We have also seen that accounts are categorized as personal, real, or nominal to help us decide how to record them. Personal accounts. These record the dealings a business has with other person or firms. This includes the proprietor's account, supplier's account, and even bank accounts. The core philosophy here is about the relationship between the business and the person. The golden rule for personal account is debit the receiver and credit the giver. If the business pays money to a supplier named Mohan, Mohan is the receiver. So we debit Mohan's account. If the proprietor introduces capital into the business, the proprietor is the giver. So we credit the capital account. This ensures we always know who owes us money and to whom we owe money. Real accounts represents the things a business owes, its assets. This can be tangible like land, building, and machinery, or intangible like goodwill and patents. These items are more or less permanent and stay with the business to help it generate revenue. The golden rule for real accounts is debit what comes in and credit what goes out. Imagine you purchase furniture for cash. Furniture is coming into the business, so you debit the furniture account. At the same time, cash is going out, so you credit the cash account. What happens if we discard old broken furniture? The answer: since the furniture is leaving the business, we would credit the furniture with account to reflect that decrease in our asset and debit the cash account if we sell that scrap. Nominal accounts are slightly different. They don't represent a physical thing or a person. Instead, they describe the reason why money was paid or received. Example include salary, rent, interest, and commission. If you pay a worker wage, the wages account tells us the nature of expenses. Even though the physical thing leaving the business is cash, the golden rule for nominal account is debit all expenses and losses and credit all gains and incomes. Since expenses decreases the owner's capital, we debit them. Since income increases capital, we credit them. If the business receives interest from the bank, interest received is an income, so it is credited. Before we move to the modern approach, let's synthesize the three golden rule of accounting. Personal account, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. Nominal account, debit all the expenses and losses, credit all gains and income. Let's apply this a quick example. If you have to pay rent of rupees 5,000 in cash, then what will happen? Rent is an expense, that is a nominal account, so we debit rent and whereas cash is an asset going out. So, going out, cash is a real asset, a real account. So, we credit the cash as per the golden rule. It is a logical, balanced process that ensures our books remain accurate. While the traditional rules are classic, many modern accountants prefer the American approach, which aligns closely the accounting equation. In this system, accounts are classified into five categories: asset, assets, liabilities, capital, revenue, and expenses or income. This approach focuses on the effect of transactions on the balance sheet. Instead of receiver and giver, we focus on whether an account is increasing or decreasing. This is often seen as more intuitive for complex financial modeling. The rules under modern approach are very systematic. Assets increase is debited, asset decrease is credited. Expenses decrease is debited and oppositely increase is credited. Liabilities increase credited, decrease debited. Capital decrease is debited, increase is credited. Increase is credited. Revenue decrease in debited and increase is credited. Note the pattern. Asset and expenses behave similarly in pattern, while liabilities, capital, and revenue follow the opposite rule. Theoretical question: if a firm borrows money from a bank, how do we record it? The answer: bank loan is a liability, so bank loan is credited. Since the liability is increases, we credit the bank loan account. Simultaneously, our cash, that is an asset, is increasing, so we debit the cash account. Let's walk through a practical exercise to see these rules in motion. Imagine we are maintaining a furniture account. We purchase furniture for rupees 20,000 on the debit side because furniture is increased. That means furniture, that is an asset, is increased. We sell furniture costing rupees 5,000. So this is a decrease in an asset. So we enter 5,000 on the credit side. We purchase more furniture for rupees 8,000 again, an increase. So we debit rupees 8,000 rupees. We discard old furniture worth rupees 2,500, a decrease. So credit rupees 2,500. After these transactions, we find the balance. Total debits. Total debits are 28,000 and total credits are 5 plus 2,500. That means 7,500. The difference, the balance is 20,500 from debit side. This tells us the current value of furniture on hand. Understanding the significance of these terms is crucial for interpreting financial system. The personal accounts, a debit balance means a person is debtor who owes money to the business. A credit balance means the person or they are a creditor to whom the businesses owes money. In real accounts, a debit always implies the acquisition or increase of an asset. You will almost never see a credit balance in a physical asset account like building unless an asset has been completely sold off. In nominal accounts, a debit signifies that an expense has been incurred, while a credit signifies that profit or income has been realized by simply looking at which one side entry sits on. An accountant can understand the nature of the business's event without reading a single word of description. As learners, you will encounter accounts that seems to sit between categories. Take outstanding salary or prepaid rent. Under the traditional system, these are called representative personal accounts because they are representing a group of people to whom money is owed or who or who owe a service to the business. In the modern system, outstanding salary is a liability because it is an obligation to pay in the future. Prepaid rent is an asset because it represents a future benefit. Brief recap: we have now covered both the traditional and modern approaches. We have seen that while the terminology changes, the result is the same: a balanced set of books where every increase in value is accounted for by a corresponding change elsewhere. Let's practice classification with a new item from our illustration: cash account. Traditionally, this is a real account, asset. Modernly, this is an asset. Bank overdraft. Traditionally, this is a personal dealing with the bank. Modern, it is a liability. Depreciation. Traditionally, this is a nominal account, that means loss. Modern, it is an expense. Goodwill. Traditionally, it is a real intangible asset. In modern, it is an asset. Whether you use British or American approach, the logic remains consistent. An expense is always a debit and an asset is always a debit when it increases. To bring this all together, we must understand the flow of information. The process begins with the business transaction supported by documents like invoices or checks. This is the first record in the journal, which acts as a chronologically diary of the business. From the journal, we post the entries into the ledger or general ledger. The ledger is likely a library where each book is a specific account. This grouping of similar entries allows us to see the total impact on cash, sales, or expenses at a glance. Finally, these balances are used to create the trial balance, the income statement, and the balance sheet. This systematic record of classifying is what we call bookkeeping, and the interpretation of this result is accounting. As you advance in your studies, you will realize that accounting is not just one field. Financial accounting focuses on overall financial state of affairs for external stakeholders. Cost accounting deals specifically with the allocation and reporting of costs to help a business price its products. Management accounting is a blend of financial and cost data used by internal manager to make strategic decisions. Regardless of the branch, the rules of debit and credit remains the foundational language used to communicate financial data. Before we conclude, we must remember the concept that guides these rules. The separate entity concept reminds us that the business is distinct from its owner. The realization concept tells us exactly when revenue should be recorded, and the dual aspect system or concept is the very reason we have debit and credits in the first place. By following these principles and the double entry system, a business ensures its records are not just numbers on a page, but a true and fair view of its financial reality. It allows for the accurate calculation of gross profit and net profit, helping the owner understand if their capital is being used effectively or not. We have covered a vast landscape today. We started with the history of the double entry system and the genius of Lucas Pacioli. We explored the T account and how it serves as a summarized record of transactions. We compared the traditional classification, that is personal, real, and nominal, with the modern approach of asset, liability, and capital with revenue and expenses. Remember the golden rule: debit the receiver, credit the giver, debit what comes in, credit what goes out, and debit all the expenses and losses and credit all the income and gains in nominal account. By applying these rules diligently, you ensure the arithmetical accuracy of your books and provide the transparency required in the modern business world. This mastery of journal and ledger mechanics This mastery of journal and ledger mechanics is your first step towards becoming a proficient financial professional. I would like you to reflect on this. If a business transaction only affected one account, would it be possible to ever truly know the financial health of a company? As we have seen, the answer is no. Balance is not just a goal in accounting, it is the fundamental requirement. Our, we will more learn in our next chapter. Till then, keep revising, keep reading. Thank you all.